Is Bitcoin the ultimate pump and dump? The crypto craze of the 21st century has certainly captured imaginations and bank accounts alike. From its humble beginnings as a single digital currency in 2009, cryptocurrency has exploded into a sprawling ecosystem with over 10,000 different coins today. Cryptocurrencies are essentially encoded units of value, transferred over the internet on a decentralized ledger. No trusted institution oversees these transfers. And the electronic units aren't IOUs. They're virtual assets, not someone's liability. Sounds revolutionary, right? But is it all it's cracked up to be? By late 2021, about 16% of Americans had invested in or traded cryptocurrencies, including a whopping 43% of young men aged 18 to 29. The market's aggregate value peaked at around $3 trillion in November 2021, right alongside the tech stock boom. By March 2022, Forbes counted 19 crypto billionaires, including Changpeng Zhao, founder of Binance, the leading trading platform. For Bitcoin, the leading cryptocurrency, there are three main sources of supply and demand: miners, early investors, and late investors. Miners use computational power to discover codes and bundle transactions into blocks on the blockchain. Early investors, including some miners, traded Bitcoin among themselves, while some criminals leveraged its anonymity. Late investors, however, are the ones who fuel the price surge, driven by the hope of future profits. But here's the kicker. Bitcoin produces no cash flow, and no one will redeem it. Early investors profit only by selling to late investors at higher prices. It's like paying a fortune for entries on no one's spreadsheet. Bitcoin's original purpose as an anonymous value transfer has transformed into a highly speculative and volatile store of value. Prominent economists have often labeled Bitcoin a Ponzi scheme, but that's not quite accurate. Ponzi schemes, like Madoff's, end in runs when investors panic and pull out. Crypto, on the other hand, doesn't collapse in a run. It crashes in price. Take May 2022, for example, when a sizable coin went to zero. Bitcoin isn't just a redistributive game. It's a deeply negative-sum game due to the high costs of mining. In a crash, aggregate losses outweigh gains by the cumulative cost of mining. So, is Bitcoin the ultimate pump and dump? In many ways, yes. As the value inflates, early investors cash out, leaving late investors holding the bag when the bubble bursts. The lesson here: be cautious and always do thorough research before diving into the next big thing. Because in the world of crypto, not all that glitters is gold. Chapter 2: Minsky-Kindleberger meets Bitcoin, the crypto roller coaster. Today, we're diving into the wild ride of Bitcoin and comparing it to the Minsky-Kindleberger framework of financial manias. Sounds intense? Let's break it down. Bitcoin started with a nerdy appeal back in 2008. A mysterious figure or group named Satoshi Nakamoto published a white paper proposing Bitcoin as a peer-to-peer means of encrypted payment. No middlemen, no banks, just pure digital currency. This idea resonated with folks who were fed up with banks after the 2008 financial crisis. Fast forward to 2013, Bitcoin's price shot up to $1,000. It wasn't just for tech geeks and libertarians anymore. It became a hot financial asset. This shift aligns with Minsky's displacement phase. Bitcoin entered a boom phase, attracting imitators like Ethereum in 2015, which introduced smart contracts and decentralized finance, or DeFi. Bitcoin hit $20,000 in 2017, and everyone, from taxi drivers to your next-door neighbor, was talking about it. Vanderberg from the San Francisco Fed calls this the euphoria phase. But with euphoria comes risk. The crypto winter of early 2018 saw Bitcoin's price drop by 2/3. Yet, Bitcoin bounced back, reaching $69,000 in November 2021. This peak brought its own set of issues. Centralized trading platforms like Coinbase and Binance became crucial, but they also introduced vulnerabilities. These platforms needed stablecoins, like Tether, to facilitate trades because traditional banks were slow to convert crypto into dollars. Stablecoins promised stability, but the crash of Terra in May 2022 and the loss of value in its sister coin, Luna, shook this promise. It suggested that the euphoria phase was giving way to distress. Players started realizing that exiting at a profit was becoming difficult. So, what does this mean for Bitcoin and crypto? It's a wild ride, much like the financial manias described by Minsky and Kindleberger. Chapter 3, From Terra to Luna and Back, the Crypto Collapse. Imagine watching your investment vanish overnight. This is the story of Terra and Luna. In May 2022, the crypto world was rocked. Terra, a stablecoin, and Luna, its sister coin, crumbled spectacularly. Do Kwon, their creator, claimed Terra's algorithmic stability was superior to traditional asset-backed stablecoins. But when Terra's value dropped below $1, chaos ensued. Investors rushed to Anchor, a smart contract linked to Terra, offering a tempting 19% interest. Yes, you heard it right, 19%, pulling out billions in days. Terra's algorithm tried to maintain its peg by creating more Luna, but this flooded the market. Luna plummeted from $116 to nearly zero within days. The fallout was massive. Celsius, Voyager, and even Three Arrows Capital fell like dominoes. The Terra Luna crash didn't just shake trust in these coins, it highlighted the fragility of the entire crypto ecosystem. The lesson? What looked like an interesting project to harness the volatility of crypto eventually proved a reckless experiment at investors' cost. Chapter 4, FTX Pump and Dump with a Twist. Are you ready to unravel crypto's craziest scandal? Buckle up, because FTX's story is a roller coaster. In November 2022, crypto giant FTX went belly up, leaving 1 million customers staring at $8 billion in losses. Founder Sam Bankman-Fried, once worth $26 billion, saw it all vanish faster than a meme coin. His crew? Pleading guilty left and right. Here's the kicker: FTX minted its own token, FTT, and pumped its value to the moon. With robots buying up tokens, FTT went from 14 cents to a whopping $80. But instead of a typical dump, they got crafty. They used FTT as collateral to secure massive loans. When the crypto market took a nosedive, FTX's house of cards crumbled. The twist? They turned your trust into cash by borrowing against their own inflated token. It's the ultimate crypto heist, folks. And that's how FTX's pump and dump with a twist went down. Chapter 5, Bitcoin, not a Ponzi scheme, but a negative sum pump and dump one. So, Bitcoin is often labelled a Ponzi scheme by skeptics. But let me tell you, that's being too kind. Bitcoin is actually worse. Allow me to explain. First, what's a Ponzi scheme? In 1920, Charles Ponzi promised investors a 50% return in 45 days and paid early investors with money from new ones. Simple, right? Bernie Madoff did something similar, offering steady returns until the 2008 financial crisis triggered a run and his scheme collapsed. The courts and a trustee managed to recover 70% of the $20 billion invested. But Bitcoin? It's a whole different beast. Bitcoin promises nothing. It's not an asset that earns income or matures. There's no run on Bitcoin. The only way out is to find someone else to buy it. Think of it like a penny stock pump and dump, but on steroids. People buy into Bitcoin hoping for massive gains, driven by FOMO, fear of missing out. Now, let's talk about costs. Bitcoin isn't just a zero-sum game, it's a negative-sum game. It's costly, burning through massive amounts of electricity. As of early 2021, miners had racked up $15 billion in electricity bills, with daily costs around $20 million. This isn't just money moving around, it's real resources being wasted. Imagine Bitcoin collapses. There's no legal framework to chase down early sellers and redistribute their profits. Unlike Madoff's scheme, there's no chance for clawbacks. The collective losses would far exceed gains, thanks to the enormous costs involved. So, why is Bitcoin worse than a Ponzi scheme? Because it's a long-running, decentralized pump and dump scheme that burns through resources at an alarming rate. When it crashes, there's no safety net, no legal recourse, and no recovery. The true cost is a massive social loss. In the end, Bitcoin isn't just a speculative mania, it's a postmodern financial black hole. Unlike a Ponzi scheme, Bitcoin's endgame won't feature frantic runs or court-ordered repayments. Instead, it's an unprecedented speculative bubble with no underlying value. When it bursts, there'll be no one to hold accountable and no way to recover lost investments. So, next time someone calls Bitcoin a Ponzi scheme, remember, that's putting it lightly. It's actually much, much worse. Thanks for watching. Don't forget to like, subscribe, and share your thoughts in the comments below. Until next time, stay curious.